Are we about to experience our own version of subprime? Hello again, I'm Martin North, Principal Analyst at Digital Finance Analytics. The RBA has just released their Financial Stability Review today. It's worth reading the 70 or so pages as it gives a comprehensive picture of the current state of play, though through the central bank's rose-tinted spectacles. They home in on the around $480 billion interest-only mortgage loans due for reset over the next 4 years, which is, they say, around 30% of outstanding loans. Resets to principal and interest will lift repayments by at least 30%. Some borrowers will be forced to sell. This scenario mirrors the rollover of adjustable rate loans in the United States, which triggered the 2008 subprime crisis. Perhaps this is our own version. Now, we've previously estimated that more than $100 billion worth of these loans would now fail current tighter underwriting standards. And one area of potential concern is for borrowers at the end of their current interest-only period. Much of the large stock of interest-only loans are due to convert to principal and interest loans between 2018 and 2021, with loans with expiring interest-only periods estimated to be averaging around $120 billion a year, or in total 30% of the current stock of outstanding mortgage credit. The step up in mortgage payments when the interest-only period ends can be in the range of 30 to 40%, even after factoring in the typical lower interest rates charged on principal and interest loans. However, a number of factors, the RBA says, suggest that any resulting increase in financial stress should not be widespread. Most borrowers, they say, should be able to afford the step up in mortgage repayments because many have accumulated substantial prepayments, and the serviceability assessments used to write interest-only loans incorporate a range of buffers, including those that factor in potential future interest rate increases and those that directly account for the step-up in payments at the end of the interest-only period. Moreover, these buffers have increased in recent years. And in addition, the RBA says, in addition to raising the interest rate buffer, APRA tightened its loan serviceability standards for interest-only loans in late 2014, requiring banks to conduct serviceability assessments for new loans based on the required prepayments over the residual principal and interest period of the loan that follows the interest-only period. Prior to this, some banks were conducting these assessments assuming principal and interest repayments were made over the entire life of the loan, including the interest-only period, which in the Australian Securities and Investment Commission's ASIC's view, was not consistent with responsible lending requirements. And as a result, 8 lenders have agreed to provide remediation to borrowers that face financial stress as a direct result of past poor interest-only lending practices. However, to date, only a small number of borrowers, they say, have been identified as being eligible for such remediation action. Some borrowers have voluntarily switched to principal interest repayments early to avoid the new higher interest rates on interest-only loans, and these borrowers appear well placed to handle the higher repayments. Some interest-only borrowers may be able to delay or reduce the step-up in repayments. Depending on personal circumstances, some may be eligible to extend the interest-only period on their existing loan or refinance into a new interest-only loan or a new principal interest loan with a longer residual loan term. The share of borrowers who cannot afford higher principal interest repayments and are not eligible to alleviate their situation by refinancing is, says the RBA, thought to be small. And in addition, borrowers who are in this situation as a result of past poor lending practices may be eligible for remediation from lenders. Most would be expected to have positive equity given substantial housing price growth in many parts of the country over the recent years, and hence will at least have the option to sell the property if they experienced financial stress from the increase in repayments. The most vulnerable borrowers would likely be owner-occupiers that have still a high loan-to-value ratio and who might find it more difficult to refinance or resolve their situation by selling the property. Now, my personal view is that the risks in the system for interest-only loans is significantly higher than the RBA is actually representing in their report. But looking more broadly at household finances, they say that the ratio of total household debt to income has increased by almost 30 percentage points over the past 5 years to around 190% after having been broadly unchanged for close to a decade. Australia's household debt to income ratio is high relative to many other advanced economies, including some that have also continued to see strong growth in household lending in the post-crisis period, such as Canada, New Zealand, and Sweden. Household debt in these economies is notably higher than in those that were more affected by the financial crisis and experienced deleveraging, including Spain and the United Kingdom and the United States. While Australia's high level of household indebtedness increases the risk that some households might experience financial stress in the event of a negative shock, the RBA says that most indicators of aggregate household financial stress currently remain fairly low, notwithstanding some areas of concern, particularly in the mining regions. In addition, they say total household mortgage debt repayments as a share of income have been broadly steady for several years. But note, of course, that this is because interest rates have been cut to ultra-low levels, and should rates rise, payments would rise significantly. The RBA says that default rates on mortgages, more than 1.7 trillion outstanding, is low, but it concedes is high in the mining-heavy states. Then they defend the situation by saying that household wealth is rising, though, of course, that's mainly thanks to inflated property values and currently being correct. And then continues to cite out-of-date Hilda survey data from 3 years ago to demonstrate that the share of households experiencing financial stress has been lowest since at least the early 2000s. But this is so old as to be laughable, remembering the interest rates and living costs have risen and incomes are flat in real terms. And the RBA also argues, again, that households are prepaying on their mortgages. We agree some are, but not those in the stressed category. Averaging data is a wonderful thing. Finally, a word on the profitability outlook of the banks. Despite the recent lift, analysts are cautious about the outlook for profit growth, they say. The recent benefits to profit growth from the widening of the net interest margin and falling bad debt charges are expected to fade, especially if short-term wholesale spreads remain elevated. The financial impact of the multiple inquiries into the financial services sector remains a key uncertainty, including the Royal Commission into Misconduct in the Banking, Superannuation and Financial Services industry, the Productivity Commission's inquiry into competition in Australia's financial system, and the Australian Competition and Consumer Commission's Residential Mortgage Product Price Inquiry. There is, they say, the potential that these may result in banks having to set aside provisions and or face penalties for past misconduct, or perhaps more notably being constrained in the operation of parts of their businesses. The RBA says that this uncertainty around banks' future earnings has weighed on their share prices, which have underperformed global peers, although Australian banks still have higher price-to-book ratios. The decline in share prices has also seen banks' forward earnings yields, a proxy for their cost of equity capital, further diverge from that of the rest of the Australian market since mid-2017. And banks' current forward earnings yields remain a little above their pre-crisis average, despite a large decline in risk-free rates since then. If you liked what you saw here today, please do like the post and leave a comment. If you've already subscribed, thanks, I really appreciate your support. And if you have not yet done so, please do subscribe to get alerts to new posts. I'm Martin North, the Principal of Digital Finance Analytics. Many thanks for watching, and I'll see you next time.